Utilizing the infinite banking and the tax-free cash growth warehouse strategy in business is one of the most advantageous ways to use this powerful finance strategy. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years now, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. In this video, I'm going to pull back the curtain and reveal the setup and application of how the infinite banking tax-free cash growth warehouse strategy can work for business and the benefits it provides. Now, rather than try to cover every situation, which would not be practical, I'm going to lay out the specific scenario that will demonstrate what I mean. Just keep in mind that the setup of the account and the application of the strategy is imminently customizable to every business. Now let's set up the parameters. For this example, we'll use a 50-year-old man classified as standard non-tobacco. He owns a service business that brings in $400,000 a year. His regular expenses are $11,000 per month. Without using the tax-free cash growth warehouse strategy, he would be losing opportunity cost of $660 a month, or $7,920 per year. For this example, we want to accomplish a few things. One, we want to make cash available within the account so that the business owner can leverage it to pay the expenses each month, thereby saving the opportunity cost. We want to safely generate as much tax-free growth as possible. And we want to create a tax-free retirement fund that the owner can tap into when he retires. With those things in mind, we need to establish an account that will allow for a sizable input of cash without losing the tax-free growth benefit of the account. That means we need a fairly high MEC limit. That's MEC, and it stands for Modified Endowment Contract. You just call it MEC for short. Simply stated, the IRS rules limit the amount of money that can be paid into this type of account without losing the tax-free growth benefit. That limit is largely determined by the size of the face value or death benefit of the account. We have another video on this channel explaining what a MEC limit is in more detail. Again, for this example, we're going to illustrate a composite design that is composed of a base whole life portion and 3 special riders. This design gives the maximum cash infusion to the cash value portion of the account, which also accelerates the tax-free growth by means of the compounding dividend interest. It also raises the MEC limit to allow for the input of the amount of cash needed to meet our objectives. For this example, we're going to design a policy with a $2 million face value or death benefit. The total face value will be comprised of a $600,000 base whole life with an annual renewing term rider making up the balance of the $2 million. The reason for that is threefold. First, again, the MEC limit is largely determined by the face value, and a $2 million face value has much higher MEC limit than a $600,000 face value does. Second, $1.4 million as a term rider has a much lower premium than $1.4 million in whole life. finally, and most important, about 92% of the premium paid for the term rider goes into the cash value of the account. This is the only time and the only way term insurance has any cash value, and it accelerates the growth of the cash value because it's the actual cash value account that receives the dividend interest that is paid to the account. We're also going to add a paid up additions rider to this design right here. And while this rider buys a little whole life each time the premium is paid, adding to the total whole life face value, the premium for the policy never increases. And about 92% of that premium is also added to the total cash value of the account. And that's where it contributes to the total of this compounding dividend interest that is paid to the account. We're also going to front load this account by means of a special one-time paid up additions rider. Again, this rider buys a chunk of whole life, which increases the total face value, raises up the MEC limit, and about 92% of it goes into the cash value right away. Now, all of these riders load up the cash value account so that right away, the client has access to a good amount of cash value to leverage for his business or anything else he wants to use it for. With the account set up and the initial premium deposits made, the client can now begin to leverage the funds to pay the business expenses. Leveraging the cash value is done by taking policy loans. These loans can be initiated over the phone with the provider, via the policy online portal, or by calling the agent on the case and having him initiate the loan for you. The funds requested are then sent by check or electronically transferred to the client's bank account. That process takes only about 5 to 7 business days. There is no tax or penalty levied on these loans. Business expenses are tax deductions, and any interest paid on these leverage loans are also tax deductions. So while all the money in this account continues to earn the compounding dividend interest tax-free, the money being used for business expenses and any loan interest paid is a tax deduction. Yeah. And by using this tax-free cash growth warehouse infinite banking strategy, the client saves all the opportunity cost that would be paid if not for this strategy. Of course, the client will want to repay the leveraged loans periodically, but these special accounts do not have any set repayment requirements. So you can repay the loans in any amounts and at any interval you choose. Now, let's look at how the cash account grows into a very nice tax-free retirement fund. With this particular design and loading the cash account up front, of course, you know, the actual life insurance does have a cost, but you can see that nearly 80%, here's the total cash value here, nearly 80% of what is paid in at the start, which is $116,147, nearly 80% of that, almost $91,000 is already in the cash account. Continuing with the annual premium deposits, which are in this case $46,147, being deposited into the account annually by the 6th year, 1, 2, 3, 4, 5, 6, by the 6th year, more than 100% of the premium, $46,147, is being added to the actual cash value of the account. And more is going in each year. So that by year 15, 5, 10, 15, by year 15, over 140% of this 46,147 is going into the cash value. See, it's 745 here in year 4, year 5, it grows by over 46,147 in the cash value. And should the client decide to retire at age 67, which is the full retirement age, then you can see here he'll have nearly $1 million in his cash value account, which he can then start using as a tax-free retirement fund. Of course, in the interest of time, I've skipped over some of the details here, but this is the greater overview of how this strategy works to greatly enhance the cash flow for business. Now, if you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below in the description box. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also in the description box below. If you'd like to apply to become a client of ours, the link to the application is in the description box below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.